I think there are short-term and long-term issues.
What is the biggest risk? Because there's so much out there. If you had to say, James, one thing that you worry about the most, what is it?
Yeah, so of all the issues you mentioned, trade with China and just the pace of Chinese growth, those to us are kind of real issues out there. The government shutdown, we think that'll eventually go away. That should have limited impact on the markets, unless, of course, there's something that occurs like in 2011 with some sort of debt downgrade. So on the trade side of the issue, the question is just, how fast is China growing? We know they've been slowing down for at least 8 or 9 years. So we've been talking about things like hard landing, soft landing. We still think they can have a quote-unquote soft landing. The government still has a lot of tools at its disposal. And so we don't think there's going to be as big a shock as some people may play out in that market.
The most amazing thing about the China story is, yes, the slowest growth in 30 years, right? So we look at it and go, wow, that's a bad headline. But at the same point, hey, 6+% growth should be the envy of most of the rest of the world.
Yeah. And what always comes up with these numbers, too, is, are these numbers, massaged at all? What do the underlying economic numbers say? And if you look at all the numbers together, what you see is that China has, in fact, been slowing down for quite some time. So this is not really a surprise. The question is, is there going to be a big growth shock, or is it just going to be a slow taper? Right now, we still think it's going to be a slow taper. And if that's the case, then international markets still have time to adjust to this. Corporations, especially here in the U.S. that work with Chinese companies, trade deal aside, can still adjust to that slowing dynamic.
What about here? How much is the slowdown making you concerned, if at all?
So I think in general, the question is, what is earnings going to look like for U.S. corporations, given potentially a slower growth rate in China over the next several years, and potentially, slower growth here in the U.S. as well, especially after a blockbuster 2018, both for earnings growth and for GDP. And the reality is, we should still see for the S&P 500 about $170 in earnings or in that neighborhood. And that represents about 5 or 6, maybe even 7% earnings growth.
Mid to high single digits.
That's exactly
it. But down from 20+%.
Down from 20+%, yes. Down from an incredibly blockbuster number that basically is unsustainable. And so if you...
In part because why? A lot of that was goosed, if you will, by the tax cuts, correct?
It was goosed, but also it was a bounce back from the quote-unquote earnings recession that we had just a couple years before that. And so you saw earnings rise tremendously, and they are going to slow down. So we are in the middle of this earnings cycle. Now, even if we only get, somewhere in the neighborhood of 5 to 7% earnings growth this year, that's still a really tremendous number. That's actually above the historical average. And so we still think we can get pretty solid U.S. equity returns based on that.
Bottom line is you remain optimistic about the U.S. equity. We'll end the year higher than we are right now.
Right now, we think so, yes.